Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Good, but not good enough, perhaps. Nvidia fails to meet sky-high expectations. The chipmaker warning of tighter margins as it rolls out the highly anticipated Blackwell chip. A big day for earnings in Europe. Will bring you the latest numbers crossing the terminal from the likes of Haleon and Man Group. Plus, President Trump says he'll hit the EU with 25% tariffs as he gives conflicting answers about his plans for levies on Europe, Canada and Mexico.
A quick check on these markets here. I'm going to do it through the lens of equity futures because this is really where you start to see the pain, perhaps, of the tariff picture, but also perhaps a little bit of paring back the outperformance we've seen in Europe relative to the Nvidia story. Your Stoxx 50 futures down by 0.5%, but DAX futures, the index that has been flying in the last 6-7 weeks, down by 0.6%. The FTSE 100 in the red as well, but the Nasdaq 100 futures higher by 0.5% despite that Nvidia read-through. The countdown to the opening trade starts right now.
Blackwell is going to be incredible across the board. And when you have a data center that allows you to configure and use your data center based on, are you doing more pre-training now, post-training now, or scaling out your inference, our architecture is fungible and easy to use in all of those different ways.
Thursday the 27th, the morning after the night before. We're talking Nvidia from the get-go this morning. After all, it's worth 400 billion more than the FTSE 100 combined. So a pretty good place to start in terms of the show this morning. And Anna, these are really good numbers. I don't kind of know what we want to think about in terms of the reason why the stock is down. But guys, these are really solid numbers. Sales beats, net revenue beats. Margins are still really, really good. Why is the stock down is the question.
Yeah, and does that take us, Kriti, then to the question about over-concentration in terms of the supplier base? Selling a lot to hyperscalers, more as a percentage of revenue to hyperscalers than they were previously.
Yeah, an 80% jump. I mean, as the guy said, it's not really a small number to scoff at there. I think it's interesting, though, because one of the big questions here for Nvidia and for the uses of these chips has been, is this too expensive to adopt? And I think this comes in after kind of the fallout of the DeepSeek story, where you did see this question of was it get cheaper then to produce these kind of chips. But is that a good thing? Bulls would argue that's a good thing for wider adoption.
He completely brushed off the DeepSeek story. He said it was a really positive thing.
Turned it into a positive.
Yeah,
exactly.
So he turned it into positive. The only thing that I can see that is a negative out of these numbers is that actually the concentration from the hyperscalers has gone up, not down.
Yeah.
And if you think about what Microsoft is doing in terms of the AI rollout and what is going on there, the fact that they are now circa 50% versus circa 40% a year ago, I think is a real challenge for the company. Their base is becoming more and more concentrated, dominated by the hyperscalers, and maybe that's the chink in the armor.
But and it speaks to this point of like, can the hyperscalers the only ones who can invest in it? To your point. But then what happened to all of the diversification talk we've heard from in the last couple of quarters in things like medical equipment, things like EVs, and we haven't actually seen that show up?
Yeah, absolutely. So we'll certainly keep an eye on anything related to technology in the European sector, in the European trading day ahead. Worth mentioning, Salesforce was pretty weak as well, so that could weigh on some of the tech names in Europe, along with the Nvidia story. Let us go to some of the earnings stories coming out of Europe. I'll start with Rolls-Royce, just because some of the numbers involved here appear to be fairly sizable. So in terms of the profit numbers, we've got something better than expected on operating profit. They're launching a £1 billion share buyback to start immediately, and those are some of the lines that stand out to me when it comes to that business. We're going to be talking a lot to some of the management of some of the businesses I'm going to mention now. LSE Group, LSEG is one of those we're going to be talking to a little bit later on. They're giving us new guidance around what they will achieve this year, seeing 2025 revenue at constant FX up 6.5% to 7.5%. So we'll certainly get into the guidance, the M&A, the growth, the strategy, all of that in that conversation. Quick word perhaps on Haleon. We've got numbers coming out there as well. We're going to be speaking to management.
Yeah. We're going to talk to a whole bunch of CEOs, CFOs this morning. We've got the insurance sector covered. We've got Haleon covered. Haleon's basically now the flu season. What happens with pain relief? It basically does all the consumer stuff that GSK used to do. And now it's called helium.
Right, and so tariffs become something of a question, don't they? And consolidation within that sector, so we'll certainly get to that one.
Yeah, the notable comment from Donald Trump yesterday, speaking of that, was that he didn't mention pharmaceuticals, which he has in previous iterations. So that's one aspect of it. I think you mentioned the car sector as well. You mentioned insurance. Swiss Re, of course, is something. We talked to Munich Re yesterday. We'll see if that shows up.
Okay, so you bring up the tariff issue. What did we actually learn yesterday? So 25% apparently is new, according to a White House briefing. This is the tariff that he's talking about putting onto Europe. However, that was then maybe muddled a little bit by the idea that this could be only applied to certain sectors. You bring up pharmaceuticals, not mentioned. Autos and other areas could be certainly on the table. What was the market's down this morning. European markets, in theory, are going to open lower because of this tariff conversation. We saw that in the futures. But what do we actually know here that we didn't know before? And isn't the picture even more confusing than it was before?
Well, isn't that the trouble with the tariff story? Is it seems to be this, even when we know things like 10% on China and we have a date, or, that's happened. We know that. But that could still change, couldn't it, in the Trump administration? We know about dates around Mexico and Canada, but then there was uncertainty around that as well yesterday, getting guidance as to from White House officials that conflicted what we were hearing from the president, essentially.
I thought it was interesting, the sectors that he did mention. He mentioned autos. He also mentioned farm products, so agriculturals, which we know has been a hard market to access for in terms of regulation. And then he goes on to talk about some of the other kind of steel and piece of it as well, because that is the overarching, that's where the tariffs have been more clearly installed. So
what I think is interesting here, from a market's perspective, you've got to think about tail risk, right? So if you are running money, you've got to think about the tail risk that is attached to this. And you don't necessarily trade on the headline, you trade on the risk associated with the headline. It's really hard to judge the risk. But if Bloomberg Economics puts a 1.5% GDP hit, if you get 25% tariffs, you get a 1.5% GDP hit, assuming that Europe retaliates. So that's the risk here. So from a European... So if you think about European assets and you think about how you're going to trade the European economy, that's your big risk. Now, maybe a tail risk, and we don't know what happens, but you have to trade off that risk now and assess your risk accordingly. And I think that's it. So while there's huge amounts of uncertainty about what happens, what we do know is that if 25% was put on, it would likely result in a 1.5% GDP hit. That's what you've got to trade on, not the uncertainty and not anything else. So that's now in the market as a realistic prospect.
It's in the equity market, it's in the currency market, it's in the bond market. Those things, it feels like we're perhaps more dependent on things like the ECB or the fiscal story there. Something we're going to be watching. Perhaps we're going to see more movement off the data that we get throughout the rest of the day. 10 a.m. UK time, Euro area consumer confidence could move the dial on those fronts as well. And then 2 hours later, you are seeing the ECB publish an account of their January policy meeting. So we are going to get some numbers around that as well. But the data dump is not over, because then at 1:30 p.m. UK time, the focus goes over to the States. About fourth quarter GDP data, durable goods, initial jobless claims. Remember, this is crucial on jobless claims because there's been a wave of federal firings as well in the States. When does that start to show up in the data? And is that something the markets react to as well? And then, of course, as Anna mentioned earlier, we are in earnings palooza here in Europe. It continues over in the States as well. Dell, HP, and, of course, Warner Brothers Discovery. And to top it all off, a little central bank speak as well. Barkin, Barr, Bowman, Harker, and others speaking later. I don't even know where to begin, Anna, but plenty of news ahead.
Yes, and if you go to midnight, if you include that, and it is Thursday in the United States when we're at midnight, we have Keir Starmer, of course, the UK Prime Minister, taking his turn to go to Washington to see President Trump. So we'll certainly be focused on that tomorrow. Let us get to some of the other earnings stories that we have not mentioned, and one of those is Man Group. Guy, you referenced it earlier. The net outflows story here, really interesting. Net outflows being reported in the full year, 3.3 billion. So this is the first fund outflows in 5 years, it would seem, from this listed hedge fund business. Let's talk to the CFO of Man Group, Antoine Forterre, who joins us here on set this morning. Antoine, thank you very much for coming in. Thanks for joining us. So let's start with that number, shall we? It looks to be pretty much what the market was anticipating this morning. What's the story behind that outflows number?
Hi, good morning, and thank you for having us. The number was well communicated. We talked about it at our half-year results. It came from one large institutional client who decided to reallocate away from their entire long-only active allocation in Q3. Underlying this, the activity has been very, very strong last year. We'll have one of our best year in 10 years in terms of gross flows. You mentioned the last 5-year periods. we've only had 5 quarters of outflows in 5 years. And if you look at the 5-year cumulative history, we've generated $18 billion of net inflows over that period. So we're positioned for growth. We're continuing to see that trend underlying in our flow number. And we've got significant opportunities ahead in activities or areas like credit in particular, as well as kind of our solutions business.
Yes, I want to ask you about the credit side of things. I know Robin Grew talked back in December about cracking opportunities available in the credit space. I know you've got Varagon, you've got a stake in that private credit business. So are you looking for targets in that area? It seems we've had a lot of conversations where you and Robin have talked about, oh, yes, we want to grow in private credit. So tell us a little bit more about what you're looking for there.
So credit is a key aspect of our strategy to diversify our investment contents, both organically, and we have very strong teams here in Europe doing high yield, investment grades and other categories, and then this has seen almost $6 billion of net inflows last year. But also inorganically, 18 months ago we acquired this direct lending business in the US. Integration has gone very well. Their underwriting is very strong. Their realized losses are 150 bps better than the market. And we continue to look at opportunities to add quality investment content that can complement our offering, fits into solution and help us grow in the future.
Good morning. Are you taking less risk?
We're not taking less risk. And we're in the business of taking risk for clients.
Yep.
But we do it judiciously, and we think this is the value that well risk-managed alternatives can bring to clients.
Is the uncertainty is really difficult to price? And ultimately, the balance sheet comes back to you and how that balance sheet is deployed. You're going to use that balance sheet to grow, but as you think about how that balance sheet is being deployed in the near term and the risk that is being taken, is the business seeing more volatility? Is the business seeing a reason to be more cautious? Are clients sounding more cautious? I'm just wondering how the Trump environment is playing into how you guys are thinking about.
I'll cover 2 bits. On the balance sheet, we have around $800 million invested in our fund, which is significant and is a key driver of growth and strategy for us. That number hasn't really changed over the last year. We recycle it actively in order to make sure that it supports our strategic priorities. On the client side, you were discussing earlier about the uncertainty and the tariff. It is clearly there, that uncertainty. But the interesting aspect, which you alluded to as well, is if uncertainty becomes the norm, then people revert, and they have to revert to the economic reality behind it. They have to revert to what tariff means for growth, whereas inflation, what does Nvidia numbers mean for the rollout of AI. And this ultimately becomes what is priced. What is key, though, is that they build, and this is what we provide, well risk-managed solutions that can help them meet their objectives.
Do you get the sense that clients are more cautious, are feeling slightly more risk-averse? Are clients taking as much, do they want to take as much risk in this current environment?
Not that we've observed. And as I said earlier, we still see significant opportunities for our products, helping clients meet this uncertainty that you described.
Well, in that same vein, is it getting more expensive to hedge then? You said you're in the business of taking risk. How costly is that getting?
It is increasing, but again, it's in the context of the portfolio that we have. A lot of our strategies tend to target a certain level of volatility, and so they naturally adjust to the risk environment in which they are. And year-to-date performance has been good over the board. Some of our main multi-strat funds, for instance, are up 1-2% in the last few weeks. So performance is good. Clients are here. We're managing this environment well.
What about the liquidity story of all of it? I appreciate what you're talking about in terms of the flows picture for Man Group specifically, but when you're looking at this market, bond market, equity market, arguably the commodity market for those who are invested there, are you seeing any cracks in the liquidity picture?
We're not seeing any cracks, but it's an area in which we spend a lot of time focused on equity, credit, OTC liquidity, making sure that we can trade our positions, which are significant, without impact for our clients.
Antoine, you talked a little about the private credit business, and that is an area of growth. We've talked about that a number of times. Just looking to get a better sense of what it is you're looking for there. Are the types of private credit funds that you're interested in opportunistic, distressed? Are there specific geographies you're going for?
So our approach is not to have competing teams. We do not have opportunistic credit, distressed credit right in the mix, so those are categories we look at. We are less exposed by virtue of being here in the UK to the US, so we're looking towards the US as well as a big area of growth for us. So we remain cautious on our approach to M&A, but it is the areas we tend to look at, mostly private credit, opportunistic in particular, in the US.
Is talent more expensive now than it was a year ago?
No, but good talent is expensive. We're fortunate that we have the size and heft to be able to attract it here in the UK, in the US, or in other jurisdictions, and we're making sure that we constantly evolve a business model in order to attract it.
So what kind of inflation rate do you see in talent at the moment? What's the kind of the labour cost?
Inflation in our business has been 3-4% overall, so well managed. And we're fortunate that if you go back to last year, we had a strong year.
Yeah.
Our earnings were up, 43%. With that, our comp pool was up, and so we've been able to reward our team fairly.
Great to see you, Anton. Thank you very much.
Great to have me.
Always appreciate you coming and seeing us. We really appreciate
Thank you.
Your time. Anton Forterre, the Man Group CFO. Plenty more earnings interviews coming up. David Schwimmer's going to be joining us. LSEG, I think we say that now, the CEO, London Stock Exchange. Not really the London Stock Exchange anymore. Ryan McNamara, Haleon CEO, and John Dacey is going to be joining us a little bit later on from Swiss Re. Plus?
Yes, so plenty of earnings conversations. Plus, we will talk about markets, of course. We will be joined by EFG Asset Management Senior Portfolio Manager to talk about fixed income markets. Yields are a little higher this morning on treasuries, but they have been coming down. And is that because of people's growth concerns in the States? Or are people convinced by Trump and Musk and Bessent and what they plan to do with yields and debt? We will get into that conversation. Annika Gupta joins us from Wisdom Tree, Macroeconomic Research Director. We'll also be joined by Henrik Dutoit, who's founder and CEO of 91. That conversation live from South Africa. This is Bloomberg.
We have made a decision. We'll be announcing it very soon, and it'll be 25%. Generally speaking, and that'll be on cars and all other things. And European Union is a different case than Canada, different kind of case. They've really taken advantage of us in a different way. They don't accept our cars. They don't accept essentially our farm products. They use all sorts of reasons why not. And we accept everything of them. And we have about a $300 billion deficit with the European Union. Now, I love the countries of Europe. I guess I'm from there at some point a long time ago, right? But indirectly, pretty directly too, I guess. But I love the countries of Europe. I love all countries, frankly, all different. But the European Union's it was formed in order to screw the United States. I mean, look, let's be honest. The European Union was formed in order to screw the United States. That's the purpose of it.
Yeah. President Trump there on the potential levies on transatlantic trade. The last bit kind of, I think, is fascinating in terms of the mindset as to where we are in terms of kind of what ultimately the European Union, he thinks, is doing to the transatlantic trade story. The European Commission responding, saying the EU will react firmly and immediately against unjustified barriers to free and fair trade. I think you need to look at the Bloomberg economics story on this. 1.5% GDP hit if 25 comes in and Europe responds. How does the market price this in? Let's figure that bit out now. Valerie's here with the details. Valerie.
Guy, it was interesting to see that a lot of the negative reaction in European assets yesterday was actually more pronounced in the equity market instead of the FX market on the recent Trump tariff threat on the EU. We had the Euro Stoxx 50 futures drop nearly 1% in a straight line after that comment about perhaps a 25 blanket tariff on all EU goods. The reaction in the FX space, there was one, but it was a bit less muted. We just had the euro drop around 0.2% versus the dollar after these comments were made. It failed to sustain above that 105 level yet again. But back to that back to that Bloomberg economics analysis that you noted. Yes, a GDP hit of 1.5%, but also a 70% decline in exports to the U.S. In the medium term. That is a steep drop, with the Bloomberg economics also noting that significant risk to autos, to the medical machine industry, and also the industrial machinery industries.
Valerie, thank you very much. Bloomberg's Valerie Teitel with an update on the tariff story. Let's continue to tackle this, I should say, from a market perspective. Ven Ram joins us, our Bloomberg Markets Live cross-asset strategist. Ven, we were just hearing from Valerie about the way that Stoxx responded to the news around tariffs from President Trump, or at least the suggestion of a 25% tariff on Europe. We'll see about timing and detail there. But we didn't see very much, and Kriti was talking about this earlier, we didn't see very much response in euro-dollar as a result. What do you make of the fact that the euro is quite resilient?
Absolutely, Anna. It's interesting that Trump should mention 25% tariffs on European automobiles or just Europe as a whole, and the euro should just shrug it off. If he had announced this at the start of the year, the euro would have been pummeled. The reaction would have been very different. But with there being some or the other announcement on tariffs from the US almost on a daily basis in recent days, the markets have kind of grown inured to them. The markets are essentially treating tariffs as a looming threat and as a negotiating tool rather than as something definitive at this point in time. That means that the euro will move further and further away from parity as the markets fade the earlier strong dollar theme. And that is especially so because if you look at the tactical trade, Anna, the ECB meets next week, and it is likely that they will signal that they are turning cautious about future rate cuts. We've already heard from Schnabel, we've already heard from Nigel saying that, look, I mean, future rate cuts aren't guaranteed. The rates may not be as restrictive as they thought earlier, and that neutral rate estimates are more academic. So I think that there's a very good chance that the ECB is going to signal that future rate cuts aren't on autopilot, aren't guaranteed, and that is going to support the euro until such time as we get to know what the US situation on tariffs, the definitive situation on tariffs is, as opposed to every headline announcement coming every other day from the administration.
Ven, where else are we seeing this all showing up? It was interesting. I was reading your notes before the show. You're talking about swap spreads and what we're seeing there. Walk us through other areas of the market, maybe less explored areas of the market that we should be paying attention to.
Well, swap spreads is a key segment of the markets we should be watching. Why should we be watching that? Because swap spreads are a useful proxy for what is known as the convenience yield. What are swap spreads? Swap spreads measure the differential between swap rates and similar maturity government bonds and provide a dipstick of sentiment toward preference for owning government bonds. Swap spreads in the euro area have tumbled to record lows and are negative at this moment, meaning bond yields are higher than swap rates. Why is that happening? Because euro area governments are looking to raise a lot of money from the bond markets via fresh issuance. Before the pandemic, Guy, there wasn't a single year when the bond sales exceeded 1 trillion euros. However, since then, they've been raising in excess of 1.2 trillion euros every single year. And this year, because of the defense outlay, the additional defense outlay that the US is imposing on Europe, it means that they will be looking to raise in excess of 1.4 trillion. So that issuance means that we have gone from a global savings glut to a bond glut, which is why swap spreads have turned negative.
Certainly something we're going to be keeping a close eye on. Of course, Bloomberg's MLive's Ven Ram joining the program. We thank you so much. You get more up-to-date analysis from him and the team. MLIV Go is the function on your terminal. He's talking about the dislocation basically between the bond market, but there also seems to be a dislocation, as Anna mentioned, between the currency picture and the bond market as well. Those usually trade kind of in line with each other. I wonder why they're spreading apart.
It seems like this defence story is certainly something, and Ven was nodding to this, concerns about more fiscal spending in Europe, expectation of more spending on defence. How does that all get squared away? Interesting in that context to see Hensoldt, one of the defence players over in Germany, actually coming out with quite lacklustre guidance for 25. But the expectation is that broadly we will see more spend in Europe, even if perhaps the US spends less in the future.
Is that how we need to think about the equity market? Because the DAX is up 14% year to date. The numbers are absolutely amazing in terms of the performance we're seeing, the outperformance we're seeing versus the United States. Is that because Europe is going to spend more money? Is this almost what we saw in the United States, but now being played out in Europe? And does it play out in the same way?
Defense is now the new defensive trade, pardon the pun, but that's exactly what's happening in this market. Coming up, we're going to explore the fixed income side of this more. EFG Asset Manager, Senior Portfolio Manager, will join the program. This is Bloomberg.
Welcome back. This is the opening trade. We are 30 minutes away from a European session that could see some downside movement. We can bring you the Euro Stoxx 50 futures down by 0.7%. And actually, that's deteriorated a little bit, become more negative just over the last hour or so. We have the Trump tariff threat, of course, of 25% versus Europe. A lot of details missing from that and a lack of clarity as to what that really means over which sectors. But that certainly seems to be one thing that's weighing. Also, some of the earnings stories perhaps also will weigh. We'll watch the car makers, of course, with the tariff threat in mind, but that's one of the factors we're dealing with. Nvidia perhaps, but actually US futures are higher, so maybe not so much the Nvidia effect. Let's have a look at the bond markets. We are seeing some green on the screen, some yields a little bit lower this morning as we continue. We were just debating what has been driving bond spreads and what has been driving expectations of fiscal spend, defence spend, Kriti. All of that has been something that the markets in Europe have certainly been having to deal with a lot.
I've got to say, it is reassuring that a lot of the investors are kind of going through the same exercise we are, which is what actually matters for some of these fund flows. Let's get a little bit more perspective here. Markets on the markets. Joining us now, Camila Astaburuaga. I did that right. Senior Portfolio Manager at EFG Asset Management joins the program. Camila, a pleasure to have you here. Before we get into the nitty-gritty of the politics and the tariffs as well, I'm looking at a chart here of the U.S. 10-year. It has moved lower, the yield, by 40 basis points in 2 weeks. What do you attribute that to?
I mean, it's just, I think that the main thing now is like the expectations on growth. So you have seen on the margin consumer, expectations, services, PMI, missing. So a lot of concerns more about towards growth. Also, I think it's all this uncertainty going on. I mean, the U.S., Trump took over and now he's fighting the tariffs side. There's also the uncertainty on the central bank side. And, of course, this is not all good for growth. This uncertainty puts companies into maybe a hold on their investment. You are also seeing some labor, discharges as well. So people and consumers being a little bit more worried as well. So I think that all this uncertainty definitely will weigh on growth at some point. How much, then that's the conversation. And then also, of course, is how much is being priced. So although tariffs are inflationary, it's more like as a one-off, potentially. So people are more worried about growth, and that is potentially pushing treasuries lower.
So then bringing it back to Europe here, if we're talking about an expectation of more fiscal spend from the UK, from France, from Germany, when does that show up in the bond market?
I mean, it's just crazy. I mean, since the pandemic, fiscal deficits have increased so much, putting a lot of countries in a very difficult situation, especially because growth hasn't come enough to compensate for that fiscal deficit. So now countries like Germany, that is, like everybody's talking about, is in a very difficult situation because they need to boost their own economy. They're facing all this defense, defense pressure from the U.S. And they have not only the debt break talks, but also their own, deficit issues. So what is going to give? I think that overall, in reality, although inflationary pressures could rise in the short term, I think that growth is what everybody's talking about, and that would push potentially spreads wider and rates lower, even if there's more supply, which is crazy because then it's like, well, what wins, But I do believe, at least in the short term, that would be more the impact and the effect.
Has the market absorbed the fact that Europe is going to have to spend more on defence?
I don't think so.
Okay.
I don't think so. I mean, again, it's like what is going to weight more. In the short term, maybe it is growth, and then people are worried more inflationary. I do believe maybe treasuries and even bonds are going to be higher at the end of the year, maybe. But in the long term, I do believe, the long term I'm saying, we have a range, between maybe 4.5% to 5%. It's something that people think is fair for the U.S. 10-year. Yeah. But we are seeing if there's more supply in the market, especially coming from Germany and the debt break, maybe you would expect then higher bonds.
If people are starting to worry about growth again, why are credit spreads still so tight?
It's crazy. There's definitely something is wrong, no? Yeah. Both cannot be true. No. I do think, we argue this a lot within the team. It's more
Which one's right?
Yeah, I'm always right.
No. I'm sure part of the team, you're definitely always right. Which one of the markets is always right?
I think spreads will likely widen. Even if they don't, for me, it's more about, are you being paid for the risk or not? What's the upside versus the downside? Yep. And spreads are at maybe not the all-time tights, but they're very near. And I do see some potential, risks to the growth. Even if it doesn't materialize completely, I do believe that that is not really pricing yet. So
okay, so if it's risks to growth that are driving yields down, there is another argument doing the rounds that it's actually some in the bond market are becoming increasingly convinced that President Trump, Elon Musk, Scott Bessent will be able to deliver a smaller spending commitment.
Yes.
And therefore issuance won't be as high as people had anticipated, and yields are their focus, and yields will come down. Do you buy into that argument at all?
I mean, I think that there's a merit to it. You never know with Trump. I mean, some people say that he looks more at the 10-year than the S&P now at the moment. I do think that, of course, Trump wants strong growth, and he wants America, the U.S. actually, to win in this, and for him to be successful. How does that look? I do believe there will be some impact potentially in spending because of the Doge. How would that trigger? I mean, they were saying like for each federal employee there are like 2 contractors, and then we don't know the derivative of all that impact yet. But I do believe that overall there are more risks to the downside on growth potentially than to the upside. So that's why.
And is that growth concern? Is it short term? Is it just people confused, unsure of the policy landscape, and soon we'll get some clarity? Or is this something that you're worried about over the medium term?
I am a bit worried about in the medium term because a lot of these decisions are companies, making with the uncertainty. They're like, well, am I going to invest or in my capex? And that could be more than just the short-term impact of consumer, situations. So I do think that maybe this is more like a 1-2 year story. I don't have any immediate worry, but I do believe that in the more medium term, this could turn lower than expectations.
All right, Camila Astaburuaga, Senior Portfolio Manager at EFG Asset Management, joining us around the table. We covered a little bit of everything very, very quickly. We thank you so much. Coming up, we're going to go back to the earnings story, an expected set of results from the London Stock Exchange. We're going to dive into the numbers, as well as the outlook for the city's equity markets. The CEO, David Schwimmer, joins the program next. This is Bloomberg.
Welcome back to the programme. This is the opening trade. We have 20 minutes until that opening trade for this Thursday, the 27th of February, and tariff concerns look set to dominate. We see expectations for a weaker start to trade here in Europe, down by 0.7%. We'll be back to that broader macro story shortly. Let's dive into some of the earnings reports we've had this morning. We have heard from the London Stock Exchange Group, or LSEG, has reported full-year total income in line with estimates, pretty much, but the company saw a slight revenue outperformance from its capital market unit. Let's get to the CEO, David Schwimmer, who joins us this morning. David, very nice to have you with us. So looking at the numbers, I wonder what the outlook for 2025 looks like to you, looks like to David Schwimmer this morning.
So 2024, a very strong year, and revenues up, margins up, a lot of new product that we have started to release at the end of last year and more coming this year. We grew across all of our businesses, and we are also operating each of those businesses more efficiently. So I feel very good about the 2024 results, and to your question, 2025 also looks very good. We've got lots more product innovation coming in 2025 as well.
OK, can I ask you a bit about the transformation of the group that we've seen in recent years, David? Because, of course, you've taken this business that was very much more in its history focused on just being a stock exchange to something that is much, much wider than that, of course, with data businesses, bond trading and the like. And, of course, I probably should point out at this point that in those businesses you do compete with Bloomberg in some areas. So I wonder what strategically you're looking for as a business, as a group, as it has evolved so substantially over recent years.
So strategically, we provide across the trade lifecycle financial markets infrastructure and data. And so what I mean by that is pre-trade, trade, post-trade across multiple asset classes and on a global basis. We are able to serve our customers and to provide the data and analytics that underpin each of those stages of that trade lifecycle. No one else in the world has the breadth of capabilities that we have, and that includes the breadth of the data, but that also includes the capabilities that we have across that trade life cycle. So our index business, our clearinghouse, the execution venues, and again, the data and analytics that is really unmatched in its breadth and its depth. So it's a unique business model. It is, and the core strategy is to serve our customers across that ecosystem.
David, good morning. It's Guy. And it is working. Well, certainly judging by the numbers.
Let's
talk about what is a relatively small part. Well, a small part of the business now, which is the stock exchange part of the business, which is relatively small, in fact, very small in terms of the overall size and scale that you now have. But let me just ask you a couple of questions on that. What I'm hearing is that private equity and other potential IPOs are going to be coming to market this year. There's a lot of them potentially in Europe. There's a pipeline that has been building up. How do you make sure that the bulk of that group does not go to Amsterdam? What does London need to do to make sure that some of it, a big chunk of it, comes to London?
So let's start with where we are today. In a broader environment, and by that I mean globally, where it's been fairly subdued in IPOs in the US, subdued in Europe, subdued in Asia, the London Stock Exchange continues to perform very well. And I think it's important to point out the broader capital raising that takes place, because there's often a lot of focus on IPOs, but if you look at the follow-on capital that has been raised, the London Stock Exchange continues to perform extremely well, and actually has raised more capital than the next 3 European exchanges combined. So I appreciate the question. We consider competition all over the world. We are the most international stock exchange, again, by far. And so there's been great reform in the London capital markets regime as of the summer of last year, where it has been made easier, more efficient. So I think very competitive. And again, to your question, David, we are significantly bigger than the other European exchanges.
All, I think, useful points. Do you think that there is an argument that needs to be made that maybe London needs to think about attracting euro-listed, euro-denominated IPOs as well? If you were to widen the lens, isn't there a greater potential for your group to take more of that going forward? What is the discussion that is happening internally with regulators, etc., about the possibility of that happening? Because that would certainly allow maybe London to become a more attractive place.
So I think that's already a capability that we have. So you can list in London if you are euro-denominated, if you are sterling-denominated, if you are dollar-denominated. And again, we are the most international stock exchange by far, and that includes relative to the Americans in terms of where our capital comes from. It comes from the US, comes from Europe, comes from the Middle East and Asia. And so one of the attractive elements of London and the London Stock Exchange is our ability to attract those listings. End of last year, Canal Plus obviously chose to list here. That's an iconic French company that chose to list in London. And we are, as we look at the pipeline, I think your question's right on target. There are lots of other opportunities. And as I look at the pipeline, I think that the currency should not be an issue.
David, it's Kriti in London. You talk about the kind of London being this international market and the largest thereof in the entire world. There's a question right now in the geopolitical space about a rehabilitation of Russia. And I bring that up not only because of your background as well, but simply because there's a question that increases fund flows, not only throughout the rest of the world, but also increased regulation. David, is that a scenario you're preparing for?
So I think probably premature at this point to contemplate any changes in, given what's going on in the geopolitical environment, any changes in the listings. As you know, we did have a number of Russian listings prior to the Russian invasion of Ukraine. We're not contemplating any changes at this point, but we will follow government guidance as to how that plays out in the future. But no point in contemplating any of that at this point.
And no change to the fund flows on the back of that either?
When you say change to the fund flows, what do you mean exactly?
Buyers of IPOs that are listed, folks that are invested in the London Stock Exchange among some of your other businesses, frankly, the users of part of LSEG's business?
So if I understand your question correctly, we've got capital coming into London from all over the world. We won't have capital coming in from sanctioned entities or sanctioned individuals, but we have capital coming from all over the world for those that are allowed to invest here. And we'll see how those flows change or modify according to the geopolitical environment. I think that's something that we'll keep an eye on, but has not been an issue at this point.
All right, LSEG CEO David Schwimmer, we thank you so much for your time, walking us through some of the geopolitics, the valuations, and of course what the future of LSEG looks like. Guy.
Let's go to consumer healthcare. Haleon out with numbers this morning, reporting a beat in full-year organic revenue. You've got organic growth looking pretty good. The profit line looks pretty good. Haleon's CEO is Brian McNamara, and he's sitting next to us on set this morning. Good morning.
Good morning, Guy. Good to see you.
What's doing well?
Listen, as you said, we had very strong organic sales growth in 2024, up 5%, and that was 6.8% in Q4. That was driven by our power brands, so brands like Sensodyne and Centrum and Panadol doing extremely well. Organic operating profit up 9.8%, so showing 100 basis points of operating margin improvement. Very strong cash flows on this business, so our net debt leverage is now down to 2.8 times. We started at 4 times as a listed company 2.5 years ago.
Yep.
Sorry. And that was in addition to providing $1 billion of cash back to shareholders through stock buyback and dividend. And given the confidence in that cash flow and outlook, we've increased dividend by 10% this year and announced another stock buyback of £500 million.
It's already been more than 2 years. OK, that surprised me. Let me ask you, time flies, doesn't it? Let me ask you about tariffs. This is clearly a big topic of conversation right now. We spoke to a pharmaceutical company earlier this week who said they'd set up a tariff task force to try and keep an eye on all of the news flow and work out what this means for their business. What are you doing in terms of planning and preparing around tariffs?
Yeah, first for perspective, our U.S. business, a vast majority of what we sell in the U.S., we produce in the U.S. Almost no exposure from Mexico and China. Little bit of exposure to Europe. We do have a plant in Canada, so we do ship products down from Canada. So as far as exposure goes, relative to some of our other consumer staple peers and what I've heard, I think we're relatively low exposure, but it's a real thing. We also have a task force. We have people working on what are the potential scenarios and how might we work them, but it's something we feel like we can certainly manage within the guidance we've given for the year.
How do you get margins higher? Is that because that's what investors are talking about? You know, they want to see if you can pick that up.
Yeah, absolutely. If you take a big step back, we listed 2.5 years ago. We have a lot of efficiencies we can drive in this business as we go forward.
Right.
One of the things we've done in this first 2.5 years is we've done a number of divestments. It's strategically the exact right moves to make, but they were margin dilutive. But it's setting the business up for the future. We also have had some translational FX issues, and over time you would expect that to work itself out. So we're very focused on meeting that medium-term guidance, which is 4 to 6% organic sales growth, organic operating profit.
Is the risk to the upside on that number? Is the risk to the upside on that number? Could you do better? You're being conservative.
At this point, I'd say we feel very good about the 4 to 6% guidance on the year.
Okay.
I feel like the answer to both Guy and Anna's question might be in your manufacturing capability in the United States. We know there's a big push there. I know you have a tariff task force. Are you looking to expand that manufacturing capacity in the States?
Yeah, I think it's too early to say. Like I said, a majority of what we sell in the States, we already produce in the States. So we have a number of plants there. We feel very good about our manufacturing footprint.
But if you're looking to produce more, would that scale happen in the States?
Well, I think too early to do. I also think, as we look at tariffs, we'll understand the impacts of tariffs. I think our focus is long-term strategically. What's the right thing to do with our manufacturing footprint? And we'll keep that in focus, obviously taking into account any of the short-term impacts that may come with the tariffs.
You've talked recently, I understand, about consolidation within the sector, Brian. Is that something, where's your role in that?
Yeah, so again, if we look back, we now have leverage down below 3. We have deployed capital, $500 million of capital to our China joint venture business, where we now have an 88% ownership. We'll take that to 100% ownership in 2025. We've done the 3 divestments, so we're certainly open to bolt-on M&A, but I have to say we love the portfolio we have. We can deliver all our commitments with the portfolio we have, but we're very open if the right opportunity pops up.
Let's talk about flu. Everybody seems to be sneezing at the moment. It seems to have come relatively late this year.
Yeah.
How does that? Is that business now stable in terms of kind of the demand that you ultimately see? But it's just a calendar effect as to when we all get sick. I'm wondering how we should think about that in relation to your business.
Yeah, I think there is a normal seasonality in colds and flu we always would see historically, and typically that could be a half a point to a point of impact of maybe growth in any given year in a super high season or low season. During COVID, that was very, very different.
Yeah,
Plus 40, minus 40%. What we saw this year is at the end of 2024 in December, we actually saw a decline in the cold and flu category in the U.S. by 15%, very similar outside the U.S.
Yep.
So now flu instances are coming back, but because of that low consumption in December, we have high inventory levels in the trade. So we'll see that kind of burn off in Q1 as we go. But I think we're in a more normal time with cold and flu, but there is a bit of a December to January, when the flu season comes.
If there was to be a pickup again, how much capability does exist within the business to ramp those products?
Oh, absolutely. We prepare to, we plan for an average season. We prepare for a high season so we can quickly react.
Brian, thank you very much. Thanks for joining us. The Haleon CEO, Brian McNamara, with us around the desk this morning. We have just minutes until the start of a European session that looks as if it could be quite negative. We'll watch cars, we'll watch a host of European stocks on the back of tariff threats. Of course, vaccine makers, the cancellation of an FDA meeting around vaccines. That's certainly something we're going to be focused on. We'll watch for read across from some of the earnings stories, Nvidia, Salesforce last night. All of that in focus.
Yeah, absolutely. Autos, as well as you had already mentioned. And some of this may just be pulling back from the outperformance of Europe. Does it continue at the opening trade? That next, this is Bloomberg.
Thursday morning, good morning. Europe had a really good day yesterday. Today it looks like it's going to be a slightly different story. There's a bunch of factors behind that. The US session is one of them. There you go. We rallied up into the close yesterday. That's the point we went at. The US faded after that, so you've got to price that in for the first kind of factor. Then you've got to think about the Trump tariff comments. That's another factor you want to think about. You've got earnings you want to factor in as well this morning. Plus you've got a few ex-divs. All of that, Kriti, leads to a little bit of red on your screen this morning.
A little bit and then a lot. And we'll start here with the Euro Stoxx 50 futures. Perhaps playing a little bit of catch up to what you saw in that U.S. session, down about 0.9% already in the futures. But that sell-off is worsening as I speak because the DAX futures, which has been the golden child, the outperformer in Europe, lower by about 1% today in the futures picture. But then it gets worse from here because even Italy taking quite a bit of a hit, Anna, when it comes to the futures picture, down about 1.3%.
Right, OK, so we'll certainly keep an eye on the Italian market. Broadly, the story then, Kriti, that seems to be weighing on sentiment does seem to be about tariffs, doesn't it? We'll see how it plays out in various geographies and in certain sectors. So autos could be certainly in focus as a result of that. What clarity do we have on tariffs? Well, not very much, but certainly President Trump continues to mention his stance wanting to take on Europe on tariffs. So watch automakers. Vaccine makers in focus. We have seen President Trump cancel a meeting with his FDA Vaccine Advisory Committee. We'll watch Sanofi, GSK, Bavarian Nordic, and we all know that the leadership of that particular part of his cabinet in the United States has raised questions for vaccine makers. So we'll watch that sector. And WPP in focus. They've given some pretty lackluster guidance. Revenue growth at -2% for 2025 in like-for-like adjusted revenue. And that was against an estimate of growing 2%. So, Guy, that's in focus.
Absolutely. Right. What is that all going to mean in terms of the opening trade? We are about to find out. It's Thursday. We're coming to the back end of the reporting season. There's plenty of ex-divs to factor in, plus a lot of corporate numbers that we need to think about, plus a macro story that seems to be the dominant theme. FTSE 100 starting a little bit negative this morning. We'll see whether that gathers a little bit of pace. Remember, these markets, as Kriti was pointing out, are expected to be opening down circa 1% pretty much across Europe. I think you probably sort of average it all together. That's what you're going to get. So at the moment, actually, these numbers look relatively good, but they may gather a little bit of pace. We've got a few tricky trades that we need to make work this morning, so it could take a little while to get some of these stocks open. But there's a whole conflagration of factors coming together to bring a negative session maybe to Europe. But remember, yesterday was a really good session. So you need to factor that into your thinking as well, Kriti.
Absolutely. A pullback from the outperformance that we've seen. That's perhaps the theme that we'll see when it comes to the DAX as well. You are seeing underperformance, though, in a lot of, I'm going to call it your core six here. Novo Nordisk, LVMH, ASML are certainly your biggest weights on this index. When you look at the upside, though, you are seeing a lot of movement in some of the smaller names, some of the energy exposed names I'm looking at here, Anna, when it comes to the likes of Shell, when it comes to the likes of other just kind of commodity names as well. But it's also important that the kind of idea of banks are also taking quite a bit of a hit. So an interesting mix this morning.
Yes, interesting. The energy sector is the only positive sector right now, isn't it? So that sector has just got its head in positive territory. Its oil services seem to be doing that. Valorec is one of the best gainers in that particular sector. But everything else really in red. But we take on board, Guy, what you were saying before about how that yesterday was a good session. So this is a bit of a reversal of that. We're watching to see how the auto sector performs, of course, with tariffs in mind. I mean, we feel like we've told this story a number of times, though, don't we, about tariffs are coming for automakers. Yep. And we don't have all of them open yet. So we'll see where that takes us. But something like Stellantis down by 2% this morning.
Versus yesterday's open, we're still up by 0.5%. So really, really strong session yesterday. We dropped this morning, we gapped lower, but the Stoxx 600 maybe down 0.5% today, but on a two-day basis is still up by 0.5%.
Interesting. We haven't got WPP open yet, but some in that sector are weaker. So the media sector is suffering a little. Publicis is down by 2.5%. So we'll wait to see how the market responds to its London-based rival.
Now, we talked a little bit about the Italian futures looking pretty grim as well. I just want to look at some of the movers on the inside of that in terms of what's weighing the index down. It's UniCredit, it's Stellantis, and to your point, it's Eni and NL as well. So you are getting that one, the banks read through and the energy read through. But then as we wait for the DAX, Stellantis, an early sign that things may not be looking good for the autos.
If you look at what is doing the damage in points terms, it's Novo, it's SAP. Now, SAP, and you and I were discussing this just before we came on air, could be a Salesforce story.
Yes.
So there could be some read across into that. ASML's in the mix, LVMH is in the mix. You've got Unilever and Diageo a little bit softer as well. But that feels like there's an index trade on this morning as well as a single stock trade.
Yes.
So it does feel as if Europe maybe is selling off on the tariffs, kind of the bigger picture narrative as well, plus also the big performance yesterday.
And might you sometimes find safety as markets are selling off in healthcare? Well, we do have concern around vaccine makers, so maybe not. Yeah. Bavarian Nordic is down by 1.5%. Maybe that's related, maybe not, but that is something we're watching, a developing story stateside as we look to see how the new administration deals with vaccines for sure.
Absolutely, and we should mention we are still waiting for the DAX to open. It closed higher by 1.7% yesterday, but early indications are that maybe that outperformance is not going to continue today. When we do see the DAX open, we will bring it right to you. Go ahead.
Sorry, just wanted to mention the London Stock Exchange just opened. Yeah. Really strong performance coming through there. That's in terms of the Stoxx 600. The London Stock Exchange is the best performing points gainer. It's up by 2.4%. So David Schwimmer's numbers, he was pointing them out as being strong. The market certainly liking what it heard this morning.
Gave me just enough time to look at the DAX. The DAX is now open, down by, as expected, 0.9%. A lot of that, of course, concentrated in the auto space. I'm looking at Porsche, I'm looking at Volkswagen, I'm looking at Mercedes. How much of that is a pullback from yesterday? How much of that is Donald Trump's comments overnight? Let's get all of this under one kind of market analysis here. Anika Gupta, Director of Macroeconomic Research over at Wisdom Tree, joins us this morning. Anika, a pleasure to have you on this program. We're talking a lot about the tariff threat. We're talking a lot about the defense spending story as well. Which one is overpriced in this market?
Well, very good morning, Kriti. I think I would say that the defense story is the story that investors should pay closer attention to. I think the tariff story is a bit muddled because at one end we do get tariff announcements, and then at the other end of the spectrum we do hear negotiations, chances for a pause or an extension, and hence investors are still muddling through what actually is at play. And so far we've heard a lot more noise than substance. If you think about it, the real concrete tariff in place is just the 10% tariff on China, whereas the rest of the tariff announcements are on hold. And obviously overnight we've heard tariff announcements on Europe, but we'll still have to see how it plays out. So I think the big focus for us here is really about Europe and its urgency towards securing its own borders.
Well, the fundamentals are certainly very much at play, but I'm curious, Anika, in the last 7 weeks or so, we've seen outperformance in Europe, and I'm questioning now the premium that's baked into some of these kind of geopolitically driven plays. Is Europe getting, I'm not saying it's there, but getting too expensive to own in some of the juiciest sectors that are catching all these fund flows?
Well, I think we have seen a bit of a concentrated rebound in European equities, and I think that's been predominantly focused around the exporters. So the exporters have had an outperformance within the European domain. And that's largely because the fear of tariff announcements had not hit us up until now. Also, we've seen a lot of front running in anticipation of these tariffs, so that's also resulted in escalation, in orders, and hence, an improvement in performance. I think now that we finally got this tariff announcement overnight, Europe is already taking that into account. It's already preparing for retaliatory measures. But at the same time, there are a number of avenues for negotiation. First and foremost, it comes back to defense. Europe has been lagging on its defense initiative, and now we're seeing a lot more commitment coming in from the UK, from France, from Germany, Denmark, really shoring up their spending requirements and spending needs within Europe. And I think that should be, a plus point from Trump's standpoint, where he said that, they're already scaling back. They already do not want to be protecting Europe's borders. So that's a step in the right direction for Europe. So there are many negotiating grounds, which is why I still believe there's further room to run for European equities. So maybe we see the exporters or primarily the cyclical segments take a pause, whereas the defensive parts of the market now have further chance of rebounding.
Anika, good morning. It's Guy. Given all of that, is Europe now an investment or is it still a trade? Because to a lot of people, it still feels like a trade. It's tactical rather than strategic.
I think Europe is very much an investment, and that's because Europe has been, kept in the doldrums for a very long period of time. So the Russia-Ukraine war, brought back an element of geopolitical uncertainty that essentially, put away foreign international investment flows coming into Europe. Now that we've seen Washington signal this shift towards direct negotiations with Russia, and moving further towards a ceasefire, that removes a very, very important geopolitical risk element that was preventing international investors from investing in Europe. So I very much feel Europe is back on the investment front for global investors, and that's a step in the positive direction. So no more is
when you say global investors,
trade.
Anika, when you say global investors, the conversations I have with US investors still remain quite cautious on Europe. Given what you've just described, that's all in the price now. What needs to happen to get US investors to become serious buyers of Europe and to close the valuation gap that exists?
Well, first and foremost, earnings. We are seeing earnings rebound, and earnings are the key driver for equity market performance. So if we see those earnings continue to rebound, as we've seen in Q4 of 2024, that should be a very important catalyst. I think the second very important catalyst for European equities will be the dialing down of domestic political risk. So we're seeing, from the German elections, a bit more stability come back in. We're seeing France now gain its budget. So a lot of the political uncertainty on the domestic front that did take place in 2024 is now starting to abate. So I think that those two factors would be very important catalysts, moving into 2025.
Anika, can I ask you about AI? Big theme, of course, anytime Nvidia reports numbers. Nvidia's after-hours performance actually relatively stable versus other earnings days. But away from the companies that are really at the coalface of AI right now, into the wider markets, where have you got most confidence that we'll see AI deliver for European businesses? If more and more are going to be using it once those models are all trained for inferencing, where are you expecting to see those benefits come through?
Yes, so Anna, we've seen, like within the DAX index, given it has more than 80% of its revenues are generated externally and internationally. That is one segment of the market that is likely to benefit. It outperformed in 2024. It started out on a very strong note in 2025, and it continues to benefit from the AI theme. So I think that we're likely to see a continuation of that take place, in 2025 as well.
And does fiscal spend, does that provide a catalyst for you, Anika? I mean, obviously, defence businesses are the obvious one there, but what are you looking for from the fiscal side?
Yeah, I think there's a very high likelihood that we are likely to see a reorientation of fiscal priorities. So I think we're going to see less spend on welfare, more spending on defense. There is likely to be a reorientation of carve-outs for, as they prioritize defense spending over other expenditures, and that could allow for a bit more loosening of the fiscal deficit here in Europe. So I think, yes, that could be a very important catalyst for the European economy going forward as well.
Anika, does euro-dollar at 104 help or hinder the bull case for Europe?
I'm sorry?
Does the currency, the potential moves in the euro, help or hinder the case for Europe?
So it very much helps, Kriti. So given the fact that Europe is an export-based economy, we have, we derive more than only 40% of our revenues locally. That 60% reliance on external revenues, shows our dependence on a weaker euro. That could also be a very important negotiating front for Europe with US on trade tariffs. So as long as the euro stays weaker, our exporters gain a competitive advantage. This is why we've seen a much stronger performance so far in 2025. And I think we have seen, we are likely to see the euro move further and further towards parity, and I think that should also benefit, the exporter advantage. And I think the stance from the ECB amongst all the central banks globally, I think the ECB provides the most clarity on its accommodative stance. We expect the ECB to continue to move towards a neutral rate of 1%, and I think they should achieve that by early 2026.
Anika, great to catch up. Thank you very much indeed. Anika Gupta, Director of Macroeconomic Research, joining us from WisdomTree. Let's talk about what is happening with the markets this morning. There's a bunch of stocks that are really moving around a lot this morning. Rolls-Royce is certainly one of them. WPP is one of them as well. But take a look at what's happening with Ferrari. Everything on that board is red, which I think is interesting in itself. But look at Ferrari, down as hard as it is. The Agnellis are selling $3 billion, a roughly $3 billion stake in Ferrari. They are going to still remain as the biggest shareholders. But I think it's interesting that they are selling at the kind of current valuations that we are seeing right now. Anyway, the market obviously logically is taking this as a negative story, and the stock is down, as you can see, circa 6.5%. Ferrari's going to buy up around 10% of the shares disposed of by the Agnelli, so that's interesting as well. Let's talk about some of the other names we're watching. Some big movement this morning. Joe Easton's got the details.
It's one big movement, guys, in Rolls-Royce. This incredible rally continuing in this stock. We're up around 15% at the moment. The company's cash flow guidance once again taking the attention of analysts. Better than expected. The beats and raises from this company cannot stop at the moment, and we're at another record high. Now, bear in mind, this stock traded for around £1 a share back in 2023, and we're above £7 for this stock now. A huge rally, one of the best performers we've seen across Europe over the past couple of years. A really big move once again in that one. Then we got WPP, as Guy mentioned, absolutely tanking this morning. The company warning of yet more slowdown seen in the advertising spending market. There was a bit of a buyback on that stock, but it doesn't seem to be taking much of the edge off that one. I think it might have just gone into a trading halt as well. There it is, ticking once again. WPP hit in the advertising space today. Then in terms of LSEG, a bit more positivity on that one. Of course, a lot of the business on the capital markets data, not just the exchange, and we are seeing strong sales from LSEG today, up around 3% at the moment for that stock. A decent return on that total income number there as well. Then over in renewable energies, we've got EDPR. This is over in Portugal. Now, some weak sales from this one. The orders missing expectations, and that one really tanking at the moment, coming down 11% for EDP over in Portugal today. Then in terms of the tariff exposure, we have seen some weakness, not just those red Ferraris. We're also seeing some red on Stellantis and Volkswagen in terms of the tariff news coming out of Trump last night. And also the drink stocks, Morgan Stanley out with a note saying that Trump's comments suggest potentially 20% downgrade to earnings estimates for some of these stocks. Then finally, going to finish on another massive price target for Rheinmetall. the company, again, another shout out for Morgan Stanley. They've put the price target at Rheinmetall on €1,300. However, they reckon that the stock could go to €2,000 if Europe starts spending at 3% of its GDP on defence. We can see where that stock traded only around a year ago, around €400. It's up to around 1,000 now. Potentially it could double, according to Morgan Stanley, and the stock once again at another record high in Germany today.
Right, yeah, some of the spending in that sector really incredible then, or expectations of it at least. Joe, thank you very much. Joe Easton from our equities team. Coming up on the programme, European automakers are lower this morning, in focus after President Trump's latest tariff guidance. We'll dive into the details of that and plenty of other stories from the auto space. Craig Trudell joins us. This is Bloomberg. Welcome back to the opening trade. 8:19 here this Thursday morning in London. And this is the picture across European equity markets. Stoxx Europe 600 down by 0.7%. The DAX under pressure, as you can see there, down by just over 1%. And in terms of other markets, yeah, we have the FTSE MIB in Italy down by 1.4%. We'll come to one of the reasons for that in the auto sector in just a moment. But it seems that the tariff story, Guy, then is one of the big themes that the markets are dealing with. But as you pointed out earlier, over 2 days, not so negative.
Yeah, the markets look pretty good. And the breadth today is really negative. So there's a lot of stocks moving to the downside. The auto sector is firmly in focus. You got a bunch of reasons for that. President Trump saying yesterday that tariffs on EU products will be 25%, could include autos. Who knows? We'll wait and see exactly what happens on that front. Joining us now, Craig Trudell, who leads Bloomberg's global automotive coverage. Let's start off with the tariff story. Did you discern any clarity from what could happen next from what President Trump said yesterday?
I mean, I think you said it best when you said, who knows? This is a sort of worst case scenario where you've got a great big cloud hanging over your head. And not only that, you have no idea when it's actually going to rain. Is it going to rain? Yep. You can only sort of prepare so much for that, potential, predicament to come your way. And there's only so much you can do in this industry, right? You can't, snap your fingers and add production capacity in the U.S. To whet Trump's appetite.
So that's one way of tackling the deficit that Trump has very much got his eye on in the autos sector between Europe and the United States is to produce more cars over in the US. Another way is to have more US cars come to Europe. But this doesn't seem as if this is, is that going to fly, Craig, in terms of demand from European consumers? I mean, you can get rid of any tariffs that exist, but will Europeans want to buy those cars that are much larger?
I think that's something we keep coming back to as a team is, how can this possibly be resolved in the sense that, the biggest U.S. automaker, General Motors, basically doesn't exist here in Europe anymore. They
sold. The American companies have been selling their footprint.
They've been gone. And so, they're trying to do a little bit of importing into some big cities with some, Cadillac electric vehicles. But we're talking like, handful of showrooms, really, really low volumes. Ford has been in this long-term trend of steadily declining sales. They do still have some local production here, but they've been closing factories because they continue to be in this bind of producing more than they can sell. And then you have Stellantis. They've got plenty of local production. Tesla has local production. There's not really a sort of big automaker that you can come up with where you can say, you know what, we can sort of balance things out here by one or the other sort of cranking things up.
This is all going to feed into the consolidation story or potential consolidation story over in the States. We're already seeing some element of that in Japan or lack thereof. Walk us through the Nissan story.
This is a huge story. So the CEO, Uchida, has been in the chair for some years now. It really has gone sideways. I think you have to take this back right to before he stepped in and Carlos Ghosn leaving the picture in 2018. This is a company that really since then has been sort of steadily in a state of, if not losing money, really weak profitability. The outlook going forward, I think, is really cloudy because there's not a whole lot of product to get excited about. And, I think that this company was holding out some hope for a rescue, some help from Honda. That didn't go very far before everything sort of fell apart. So I think, the writing is on the wall here that they need help. And the question is, will Honda re-enter the picture if Uchida steps down? And who can possibly sort of take over and help, sort of steady things for this company?
Let's talk about Ferrari. It's in the red this morning, as all Ferraris should be, but probably not exactly what everybody would hope for. So I had this theory that the Agnellis are selling because Ferrari's decided it wants to produce an electric car. Now, I'm sure I'm not correct in this, but it feels like a pivotal moment for the company. If it's not because they've decided to go down the electric route, which doesn't work out well for Porsche, what is it? Why are they selling? What's going on here?
I think this is a company that, is really, I don't know, it's not necessarily, the case that anything is simple or easy in the auto industry.
No.
And yet this is a company where you effectively run it by not necessarily turning the dials all that much. And so...
Yeah. It's the Hermes of the car
Exactly.
space. Yeah.
And so, to your point, there is some radical product coming that, does raise some real questions about, is this the right move? And yet I don't necessarily see things going sideways for Ferrari with an electric model quite like we've seen with Porsche. This is a company that will continue to be relatively low volume, even much lower volumes than Porsche.
So, is this portfolio adjustment? Is this what are they doing?
I think it's a highly valuable company within their portfolio. I think they have trouble elsewhere in their portfolio. Stellantis being a company that is really struggling, as we've seen just in the last few days with a latest look at their financials. And I think they also mentioned Exor last night, an acquisition. And so I think we may see a sort of next turn here, and it all makes a little bit more sense why exactly they're taking some cash off the table in the form of some Ferrari shares.
So we see that stock is down substantially today, race down by just over 7%. Elsewhere in the auto space, yes, there's some weakness, but not staggering amounts of. I mean, are we just waiting for facts on tariffs? And until we get real facts and actually implemented policy, perhaps, or dates, are we just in limbo here?
I think so. I think this is a sector that's been beaten down, pretty solidly going back to last year, and it's in part a factor of the tougher sledding. Right? You've seen the Chinese manufacturers come on the scene in a really emphatic way. Lots of reasons to be concerned. I think even just in the last few days, we've seen indications of BYD getting more aggressive here in China. I think everybody sort of, saw these Chinese companies coming into the European market and assumed they were undercutting on price. Yep. They weren't necessarily yet. Now we're seeing BYD start to get even more aggressive.
Craig Trudell leading our autos coverage around the world. We thank you so much. Coming up next, we're going to dive into the Nvidia story. Is it a positive number or a negative number? We're going to dive into the details next. This is Bloomberg. This is the opening trader at 30 minutes into today's session. You are seeing red across the stream. Stoxx 600 down about 0.7%, but real underperformance in what have been the winners of the past couple of weeks. The DAX, for example, down about 1%. Seeing some pretty big negativity across the board as well. We are specifically keeping a close eye on European chipmaker stocks in this hour, tracking the read across, of course, from those Nvidia earnings. And we did see shares in the AI chipmaker fall after hours trading after delivered good, but not great quarterly numbers, drawing a fairly muted response for investors. Let's do a little bit of investigative work here and bring in Matt Bloxham from our Bloomberg Intelligence team. All right, Matt, walk us through this reaction.
Yeah. I mean, obviously, this is in the context of a month or so of DeepSeek news and these fears that that's a real big disruption to the kind of AI model, and that ultimately the big tech companies that are spending tens of billions of dollars each on Nvidia chips won't need to spend as much because the the kind of performance and efficiency of AI models will improve drastically. So you'll still get expansion of AI, but at much lower cost. And I think that question has not been answered. I don't think it will be anywhere close to being answered until next year. So I think, to some degree, what we saw here was, some expectations going into numbers that these are going to be really strong in terms of the absolute numbers, but the ability for Nvidia to keep really surprising on the upside is diminishing, because we've had a few quarters where they have surprised. So inevitably, the market reacts to that. Yeah. Analysts move their numbers up, get a bit more optimistic. And I think the slight kind of fly in the ointment here was the margin story. We were looking at some of the client chats yesterday as people talked through what they're expecting, and the optimists were hoping that the margin print would be better, and it was in line. It was 73.5%, I think, and they guided to similar margins to that for most of this year, with perhaps a bit of an improvement towards the end of the year. So I think that glimmer of margin boost would have maybe helped the stock, but because it was just in line, kind of saw a little bit of selling.
I just want to make a quick point on the analyst story, because the minute you mentioned it, I pulled up on our screen. Nvidia shares closed at about a 131.28. That's the street low on the analyst screen. The street high is 220. So that's how bullish sentiment is right now from the analyst community.
Yeah, I think there's been a mindset shift, right?
Yeah.
Around this stock. It's never really recovered. It's down on the year, never really recovered from the DeepSeek hit. And it does feel as if previously there was kind of no caution. Mm-hmm. If you'd have posted these kinds of numbers a year ago, the stock may have had a very different kind of reaction. But it does seem... Do you feel that there's been a sort of mind sort of shift? There's been a shift in the narrative around the stock that almost regardless of what they'd posted yesterday, the caution would have been there. That there has been a change in the way that Nvidia is viewed and how important these numbers are.
Yeah, to some degree. I think inevitably, if they'd really been on the upside with revenues, there would have been a good reaction. But yeah, I think there has been a narrative shift around not just Nvidia, but the whole AI space.
Yeah, exactly.
And I think you see a lot of questions for Meta, for Google, for Apple, for Microsoft, Amazon. These tens of billions of dollars you're spending, 50% increases year on year in capex, mainly on AI and data centers. When are you going to get a return on investment on that? And nobody's got a clear answer. There isn't huge confidence. They just know that this is everything's moving towards AI.
That's the question everybody wants an answer to.
Yes, and it's the question that every enterprise is starting to look at too. Okay, last year enterprises played around with AI. Where is the productivity gain? Where is the sales gain? And if they're going to continue to invest in AI, they need to see that. And that's not going to come through until next year.
And that's partly why Salesforce numbers were disappointing yesterday. Agent Force is their tool, which...
that's a really cool name.
Isn't it?
But it
only produced a modest contribution this year. More next is the line, as if we have to wait a little bit longer for Agent Force and all similar forces to get into action. Matt, thank you. I don't know why that's funny. Thank you very much. Matt Bloxham from Bloomberg Intelligence. Matt was talking there about data centres, and sticking with the AI theme, Bloomberg's Francine Lacroix spoke with the Brookfield Asset Management CEO Bruce Flatt about prospects for artificial intelligence and its infrastructure, including data centres.
The thing that I guess that hasn't really been factored in yet is that data center build-out really only started 10 years ago, and it was just getting started for cloud, and then the ChatGPT moment happened, and the amount of increase in requirement to train models and for learning is very, very significant, and we're talking trillions and trillions. So the opportunity for us, as we've always tried to move our backbone of the global economy along with what's changing in the world. And increasingly today, the world is digitalizing. And the final step of all of that is providing compute capacity. And so we continue to work on opportunities like that. But these are large, large sums of money. Some of these sites, like a 1,000 megawatt, 1 gigawatt data center site is with compute capacity, power to compute capacity all the way through is $50 billion. These are almost unprecedented investments ever seen in hundreds of years.
But are we overestimating or underestimating the pace of change that this needs to get done?
I would say you never know at the moment in time. But if I had to guess, we will. Everyone gets excited sometimes, but in the next 10 years, we will look back and be extremely surprised at the progresses that have been made. And probably the most important thing is that really what's happening is that it's the application of artificial intelligence into service businesses and industrial businesses, and the compression of the component of labor. And because of that, the productivity advances are going to be very significant. But that's going to be good for America because it means you can reshore capacity that you couldn't have made in the United States before, and that's going to continue to happen over the next 10 years.
Has DeepSeek changed anything for you?
I think all it does is show that when advances get made, they continue to get made, and progress, smart entrepreneurs figure out another way. And I'd say it makes the point. We are going to have better technology every day. We're all learning. And I'd say for us, what's really important is we provide the backbone of all of that. So we're providing the green power, we're providing the data center, we're providing the compute capacity, we're funding all of that. And that's different than, we don't own a competitor to DeepSeek. If you did, you might worry about whether you had that. What it does mean probably is that there's more capacity required, which means they need more of our backbone. And as you bring costs down with anything, more use cases come about. And that's what's going to happen in the next 10 years as we evolve this business.
That was the Brookfield Asset Management CEO, Bruce Flatt, speaking, of course, with Bloomberg's Francine Lacroix.
Let's talk about some of what we've just been discussing, but from a different angle. President Trump says he'll impose 25% tariffs on the EU, quote, very soon, and they'll be directed at cars and other items. Not entirely sure there was much clarity there. The president also took a new aim at the bloc, saying the EU has taken advantage of the United States and was basically created to undermine the United States. Let's bring in Bloomberg's Brendan Murray, who leads our global trade coverage. Brendan, I don't often see the word murkiness in a Bloomberg headline, but there is one this morning that has murkiness in it. Can you look through the murkiness? Is there any clarity you can discern in what we heard yesterday from the president?
Yeah, it seems that Donald Trump has made so many tariff threats, he's having a hard time keeping track of the timeline for the rollout of them. I think what we heard from him yesterday was making a distinction between the tariffs that he's threatened on Canada and Mexico, which he's using as a negotiating tactic to extract what he wants out of the drug trafficking and migration issues. He seems to be the other way he's using tariffs is to rebalance what he sees as an unfair trade relationship. That's what it seems he's pointing the 25% tariffs that he said on all EU products, cars and everything else is what he said. That he's using it to reset that trading relationship. It's in the neighborhood of $800 billion to $1 trillion more in the U.S.'s advantage. He's made the example of cars. So he mentioned cars yesterday. So that appears to be in the 4 to 6 week time frame that he's laid out between the March 4th Canada and Mexico tariffs and the April 2nd deadline for all the others.
Brendan, some pretty strong language in response from the European Union. Is that all bark rather than bite?
I think it's a bit of both, but his response to a question about any kind of retaliation was, bring it on. He said, we're a bigger economy. He called the U.S. the pot of gold that everybody wants a piece of. And he said retaliation by the EU won't work because we've got a bigger economy and a higher pain threshold than you do. So it sounds like it's typical tough talk from Trump. So we'll see if he follows through. But it sounds like he's at least willing to risk a trade war to resolve these issues.
It does seem then that as if there is still a lot of murkiness, to use the word Guy references, around trade tariffs and what they will look like for Europe, Brendan. But I know that Bloomberg Economics has done some work on the suggestion that we get a 25% tariff on Europe and what that will do to GDP. I think 1.5% would be the hit to GDP. These are the kind of stakes. This is the kind of damage that Europe could suffer as a result of this.
Yeah, exactly, and I don't think that includes any analysis about the damage to the U.S. economy and all of the uncertainty that it creates for businesses and consumers. Even, we'll have to watch as we see economic data roll in over the next several weeks whether things like consumer confidence, business confidence are taking a hit from all this uncertainty.
Bloomberg's Brendan Murray joining us from Cape Town, of course, covering the G20, but also giving us the updates on the Trump tariff situation. We thank you so much. Coming up on the program, we're going to speak to Swiss Re Group CFO John Dacey after the Swiss reinsurer posted full-year earnings that beat the average estimate. More on that next. This is Bloomberg.
Biggest possible risk for us as a company would be, I think it's clearly geopolitical risks. We are living in a more and more uncertain society. Political beliefs, which had been stable for decades, seem to be less stable or less certain nowadays. And I think this is the biggest risk we have currently.
The Munich Re CFO Christoph Jürger there speaking to us yesterday about geopolitical uncertainty being the biggest risk on the horizon for his business. Let's talk about other risks for the reinsurance sector. Swiss Re says it expects claims from the Los Angeles wildfires to be under $700 million as the reinsurance and insurance provider saw net income rise to $3.2 billion in 2024. The Swiss Re Group CFO, John Dacey, joins us now. John, thank you for joining us. We just heard Munich Re talking about one big risk, which is geopolitics. Your earnings take us in the direction of another big risk, which is, of course, around climate. So let me ask you about the impact of the LA fires, either directly or more generally. We've talked about the numbers. Are you then going to reduce exposure to this kind of risk as a result of these fires? Is that an obvious conclusion?
Yeah, so just to be clear, we expect Swiss Re's losses for these fires to be less than $700 million, as you said. We think the industry losses to be approximately $40 billion between the primary insurance and the reinsurance sector. We don't expect at Swiss Re necessarily to pull back from these risks. What we do expect is to be able to price these risks correctly for both the underlying asset values, which are being insured, but also for the nature of the dynamic of the risk itself. And what we saw in January between the 7th and 9th, between the two large fires in Eaton and Palisades, was a massive conflagration started by what was an incredibly dry season, the 6 months preceding, where no rain had fallen. And then the Santa Ana winds, which were sustained at levels which actually hindered the firefighting abilities of the authorities for the first 36 hours. And it's one of the reasons why 16,000 structures were destroyed and why the losses were so concentrated and large in the complexity.
Yes. Yes, so one of the things you can do then is you can charge customers more for that kind of protection. I wonder, and I wonder what this means for the sector more broadly, and whether you'll be increasing your attachment points. So for reinsurance businesses, the point at which they step in and help or support the primary insurer, are we going to see higher attachment points in the sector?
Well, our business model for the reinsurance is truly to take the tail risk of the industry. And that's what we've been doing for decades. And that's actually the attachment points we're currently at are ones we're comfortable with. It's one of the reasons why our losses are contained. Less than $700 million is still a very large number. Swiss Re in 2024 paid $37 billion in claims across our property, casualty, and life and health businesses. So it's not that we're not prepared to take on risks and to pay claims. What we need to be sure is that everyone including individual policyholders, but local governments, has a clear understanding of what these risks are and the prices that should be able to be charged to cover a reasonable insurance policy for them. Our goal is to make insurance available. We just want to be sure that to the degree that there are mitigating actions that can be done either with building codes or actually individual behaviors, that those actions are put in place to help reduce the ultimate cost of loss.
Good morning, John. It's Guy. In the background, obviously, you have a huge investment portfolio, and what we are seeing in financial assets at the moment is an increase in volatility. How's the portfolio doing? Are you having to take out a bit of insurance for that as well?
Now, it's a great question because, as you correctly say, a great part of our earnings comes from the investment income that we are able to earn on the assets that we maintain to eventually pay claims. Our portfolio is relatively de-risked. We don't have an enormous exposure either to listed equities or to other volatile assets. And in that context, our fixed income portfolio over the last 3 years has been performing better because interest rates generally, U.S. dollar in particular, has been rising in the durations that we care most about. And so we don't, while we're concerned about the volatility in these markets, we're not directly exposed in any large way to volatility in financial markets.
Okay, so let's talk about that kind of relatively low-risk portfolio you're talking about. Are you anticipating that yields are going to stay higher for longer?
Yeah, so our we've again the duration of our liabilities tends to be between 5 and 6 years. We have an asset portfolio which largely matches that, and so what we've been doing is replacing expiring bonds that might have been bought when rates were lower in 2019, 2021 with the current rates. That's helped us get a better return through either government securities or highly rated corporate credit. And we'll continue to do that, and we think this will continue to be positive to the earnings growth of the Swiss Re, at least.
John, I want to go back to the point that Anna had asked you about. It's Kriti in London, by the way. You made a point around some of the climate kind of effect in terms of California and the fires there. There's also other parts of the United States you're exposed to that has that climate risk. You said the word repricing for the risk itself. That basically means higher premiums. Are you seeing a shift in demand for those higher those insurance policies at that higher price? Are people more or less willing to kind of tap that kind of insurance policy?
So the quick answer is yes. What we see is that this risk is not something we're making up. It's evident to everyone. And whether you're in Spain and see the floods that occurred in 2020, the European storm Boris in 2024, excuse me, also last year, the 2 hurricanes in Florida that came up, Hurricane Helene, which came not only through Florida but also into the Carolinas, all of these risks need to be evaluated. We run a set of more than 200 proprietary models for individual perils where we update as often as need be, but typically on a yearly basis, what these risks actually look like and what the asset values that are at risk are moving towards. And one of the challenges we have is people continue to want to live and build and construct in areas which are relatively high risk, whether it's 100 yards off the coastline of whatever country you're interested in, or in areas where people haven't built before but might be floodplains or at risk of these sorts of wildfires in Australia or in California. And so we need to help people understand what those risks really are and use these models to price them accordingly so that, in fact, people can make informed decisions about whether they want to put themselves in more risky or less risky positions.
So it sounds like you're saying that you are actually seeing demand despite that repricing to the upside, which brings me to another question around your one of your life businesses. You have there's a reinsurance deal between Equitable and RGA announced on Monday. I think it's about $32 billion of liabilities. Is there scope for more deals like that, perhaps even bigger in size?
I'm not sure even bigger in size, but yes, Swiss Re is active in this space. We see many of these transactions as they're being contemplated, and we work with life insurance clients literally around the world and do a number of these transactions ourselves. In this particular transaction, we chose not to move forward, but Equitable is a great company. RGA is a great company. We think that there will continue to be an optimization of portfolios, and reinsurers can be very helpful in that optimization. Swiss Re first among them.
Thanks very much. Thanks, John. Good to speak to you. Swiss Re's Group CFO, John Dacey. Kriti, we've dealt with a lot of earnings stories this morning. The tariff story, clear to see the effect of that on markets, but we still have plenty to come this morning.
We absolutely do. We are just beginning what's going to be a very full trading day, starting with some of the data right here in Europe. At 10 a.m. UK time, about an hour out, we get that Euro area consumer confidence data, and then about 12 hours later, 2.5 hours later, let me do my math there, 12:30 p.m. UK time, the ECB publishing an account of that January policy meeting. Stay around for one more hour and you'll get a data deluge out of the States. Fourth quarter GDP, January durable goods, initial jobless claims as well, and then a slew of earnings and Fed speak coming from the other side of the Atlantic.
Yeah, it's a busy day coming up. You've also got this Prime Minister's meeting, Prime Minister Starmer, President Trump. That's taking place in Washington a little bit later on. Technically, it happens on Thursday, the 27th. We'll be reacting to it first thing tomorrow morning. Obviously, this is part of the UK's, this conversation will be part of the UK's plan to build defence spending. The ask, though, is America still needs to provide a backstop for any truce between between Russia and Ukraine, and the United States needs to provide a backstop to that. At the G20, the UK's Chancellor weighing in on the need for increased defence spending ahead of that meeting.
We increase spending on defence to play our full part within NATO and to keep the continent of Europe safe against Russian aggression. In terms of the future trading relationship between the UK and the US, last time that President Trump was in the White House, trade and investment between our two countries increased, and I have every confidence that that can happen again.
Rachel Reeves, speaking in Cape Town. Starmer's ask is basically this. We will provide a lot of the troops in Europe going into Ukraine, but we still need you. Yeah. President Trump has said basically it's in your backyard, it's your problem. Where is the overlap ultimately going to be in that conversation?
Yes, and that's the specifics around Ukraine. We've heard from the UK Prime Minister just yesterday, then, Kriti, increasing defence spending and more broadly, a real realisation that the price of a US security umbrella, the extent to which that still exists, that price has just gone up.
The cracks of the relationship, the transatlantic alliance surely showing. Marco Rubio also was supposed to have a meeting with the #2 over in the EU, Kaja Kallas. That meeting actually got cancelled despite her trip to D.C. Risk sentiment is low in Europe. You're seeing that on your board. It does it for the opening trade. The Pulse is up next. This is Bloomberg.